Hello and welcome to the Investing Iguana, where we help you make smart and informed decisions about your money. I'm your host, Iggy, and today we're going to talk about one of the most popular topics among Singaporean investors, bank stocks. Specifically, we're going to compare the three local banks, DBS, OCBC, and UOB, and see which one gives the most dividends. Dividends are payments that companies make to their shareholders as a way of sharing their profits. They are usually expressed as a percentage of the share price, which is called the dividend yield. Now, you might be wondering why we're focusing on dividends. Well, there are several reasons why dividends are important for investors. First of all, dividends provide a steady stream of income that can supplement your salary or other sources of income. Second, dividends can help you reinvest in more shares of the same company or other companies, which can boost your returns over time. Third, dividends can also signal the financial health and stability of a company. Generally speaking, companies that pay consistent and growing dividends tend to have strong cash flows and earnings. So, how do the three local banks fare in terms of dividends? Well, let's take a look at some numbers from 2022. According to Dollar Bureau, DBS Bank paid a quarterly dividend of 36 cents per share with a dividend yield of 4.18%. On the other hand, OCBC and UOB usually pay dividends half-yearly with dividend yields of 4.65% and 4.23%, respectively. A dividend yield of 4.65% makes OCBC the best dividend pick among the three banks. However, dividend yield is not the only factor to consider when choosing a bank stock. We also need to look at other aspects such as earnings growth, valuation, capital adequacy, and market share. Let's dive deeper into each of these factors and see how they affect our decision. Earnings growth is the increase in net income that a company generates over time. It is an indicator of how well a company is performing and how profitable it is. Earnings growth can also affect the future dividends that a company can pay out. The higher the earnings growth, the more likely a company can sustain or increase its dividends. Based on our research, DBS, OCBC, and UOB delivered strong earnings growth in 2022, with net interest income increasing by 53%, 60%, and 53% year-on-year, respectively, in the fourth quarter. Net interest income is the difference between the interest income that a bank earns from lending and the interest expense that it pays for deposits and borrowings. It is one of the main sources of revenue for banks. The strong earnings growth was driven by higher net interest margins, NIM, which is the difference between the average interest rate that a bank charges on loans and the average interest rate that it pays on deposits and borrowings. NIM is another key indicator of a bank's profitability and efficiency. According to SG Investors, DBS, OCBC, and UOB registered NIM expansion of 15 basis points, BPS, 25 BPS, and 27 BPS quarter-on-quarter, respectively, in the fourth quarter. This was mainly due to rising interest rates in Singapore and globally, as well as higher loan demand from consumers and businesses. Among the three banks, OCBC had the highest NIM of 2.05% in 2022, followed by UOB with 1.98% and DBS with 1.93%. This means that OCBC was able to earn more interest income per dollar of loans than its peers. Valuation is the measure of how cheap or expensive a stock is relative to its earnings or assets. It can help us determine if a stock is undervalued or overvalued by the market. One of the common valuation metrics for bank stocks is price-to-earnings, PE, ratio, which is calculated by dividing the share price by the earnings per share, EPS. According to Dollar Bureau, DBS had a PE ratio of 14.6 as of February 2023, while OCBC had a PE ratio of 12.9 and UOB had a PE ratio of 11.9. This means that DBS was trading at a higher multiple than its peers, implying that it was more expensive or had higher expectations or had higher growth prospects than its peers. On the other hand, UOB was trading at a lower multiple than its peers, implying that it was cheaper or had lower growth prospects than its peers. OCBC was somewhere in the middle. Of course, PE ratio is not the only valuation metric that we can use. We can also look at price to book, PB, ratio, which is calculated by dividing the share price by the book value per share. Book value is the net asset value of a company, which is the difference between its total assets and total liabilities. PB ratio can indicate how much investors are willing to pay for a company's assets. According to Dollar Bureau, DBS had a PB ratio of 1.8 as of February 2023, while OCBC had a PB ratio of 1.3 and UOB had a PB ratio of 1.2. This means that DBS was trading at a higher premium than its peers, implying that it had higher quality assets or higher return on equity than its peers. On the other hand, UOB was trading at a lower premium than its peers, implying that it had lower quality assets or lower return on equity than its peers. OCBC was again somewhere in the middle. Capital adequacy is the measure of how well a bank can withstand financial stress and losses. It is usually expressed as a ratio of a bank's capital to its risk-weighted assets. Capital is the amount of money that a bank has raised from shareholders and retained earnings. Risk-weighted assets are the total assets of a bank adjusted for their riskiness. The higher the capital adequacy ratio, the more resilient a bank is. According to Statista, DBS had a capital adequacy ratio of 16.8% as of December 2022, while OCBC had a capital adequacy ratio of 16.6% and UOB had a capital adequacy ratio of 17.9%. This means that UOB had the highest capital buffer among the three banks, followed by DBS and OCBC. The minimum capital adequacy ratio required by the Monetary Authority of Singapore, MAS, is 10%, which all three banks have comfortably exceeded. However, the MAS has also imposed additional capital requirements for systemically important banks, DSIBS, which are banks that are deemed to have a significant impact on the stability of the financial system and the economy in Singapore. DBS, OCBC, and UOB are all classified as DSIBS by the MAS, and they are required to maintain an additional capital buffer of 2% by January 2024. This means that they will need to have a capital adequacy ratio of at least 12% by then. Market share is the percentage of a market that a company or a product occupies. It can indicate how competitive and dominant a company or a product is in a given market. For banks, we can look at their market share in terms of deposits, loans, and cards. According to Statista, DBS had a market share of 32% in terms of domestic banking unit deposits as of December 2022, while OCBC had a market share of 23% and UOB had a market share of 22%. This means that DBS had the largest deposit base among the three banks, followed by OCBC and UOB. Deposits are important for banks because they provide a source of funding for lending and investing activities. They also reflect customer loyalty and trust in a bank. According to Statista, DBS had a market share of 31% in terms of domestic banking unit loans as of December 2022, while OCBC had a market share of 22% and UOB had a market share of 28%. This means that DBS had the largest loan portfolio among the three banks, followed by UOB and OCBC. Loans are important for banks because they generate interest income and fees for the banks. They also reflect customer demand and satisfaction with a bank's products and services. According to Statista, DBS had a market share of 30% in terms of credit card billings as of December 2022, while OCBC had a market share of 15% and UOB had a market share of 18%. This means that DBS had the largest share of the credit card market among the three banks, followed by UOB and OCBC. Credit cards are important for banks because they generate fee income and interest income from cardholders. They also reflect customer preferences and spending habits. According to the Straits Times, DBS led in customer satisfaction with 75.9 points in 2022, followed by Citibank with 75 points, and OCBC and UOB, which both scored 75 points. Customer satisfaction is important for banks because it can affect customer loyalty, retention, and referrals. Customer satisfaction is measured by the Customer Satisfaction Index of Singapore, CISC, which is conducted by the SMU Institute of Service Excellence, ISE. The CISC survey found that customer perceptions of quality were driven by considerations of whether banks had their best interests at heart and whether products and services were available when they wanted them. So, based on these factors, which bank stock should you invest in? Well, there is no definitive answer to that question, as different investors may have different preferences, risk appetites, and time horizons. However, here are some general guidelines that you can use to make your own decision. If you are looking for the highest dividend yield, you might want to consider OCBC, which offers a dividend yield of 5.4% based on its current share price. However, you should also be aware that OCBC has the lowest NIM and PE ratio among the three banks, which could imply lower profitability and growth potential. If you are looking for the highest earnings growth, you might want to consider DBS, which achieved a record net profit and return on equity in 2022. However, you should also be aware that DBS has the highest PE and PB ratio among the three banks, which could imply higher valuation and lower margin of safety. If you are looking for the highest capital adequacy, you might want to consider UOB, which has the highest capital adequacy ratio among the three banks. However, you should also be aware that UOB has the lowest market share in terms of deposits, loans, and cards among the three banks, which could imply lower competitiveness and market presence. Of course, these are not the only factors that you should consider when investing in bank stocks. You should also do your own research and analysis and consult a financial advisor if necessary. Remember that past performance is not indicative of future results, and that investing involves risks and uncertainties. That's all for today's episode of the Investing Iguana. I hope you learned something new and useful about bank stocks. If you enjoyed this video, please give it a thumbs up and subscribe to our channel for more investing tips and insights. Also, feel free to leave a comment below and let us know what you think about DBS, OCBC, and UOB stocks. Which one is your favorite and why? We'd love to hear from you. Thank you for watching and see you next time on the Investing Iguana.